Welcome to the Market Huddle with macro strategists Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's January 18th, 2019, episode number 11. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for taking the time out to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple beers to talk about the week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
The show is broadcast as both a podcast and on YouTube. So if you're enjoying this as a podcast and feel like you're missing out on those charts or videos that we're referencing, you can register at the markethuddle.com website and get the weekly email, which includes the chart pack and video links, or just flip over to YouTube. In this week's episode, we discuss the whale of a trade in the S&P 500 options market, and we get into the steeper on the treasury yield curve.
In our This Week in Trading History segment, we look back to this date in 1991 when the Gulf War started. And for our WTF clip of the week, we pay homage to William Wallace.
And then we're going to wrap up with the 5 most important things to watch next week. So let's jump into it. First off, Kev, who's our sponsor this week?
Well, it is a very apropos sponsor. It's Stranger Than Fiction.
Okay.
Yeah, Stranger Than Fiction. And we have to be honest here. Usually we open the beers on air and start drinking right at the beginning of the show.
Yes.
Yeah, but we started a little early today. You're actually in Vancouver, so we're running a little late, and I couldn't wait. So anyways, let's have a sip and say what we think of this. It's definitely...
It's not... Yeah.
Yeah, so it's, I actually was kind of, when I read it, it said hops, Cascade, and Nugget. And I thought first it said nougat. And I was like, why are they putting nougat in the beer? You know, these millennials with their beers. But then I realized I've gone and looked, and this shows you how much I know. There's something called Nugget hops. So that's what we're drinking, something with Nugget hops. So be it. Anyways, thank you for... Collective Arts for sponsoring us with Stranger Than Fiction.
All right, Kev, get into your legal disclaimer.
Okay. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as an investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
Kev, let's get to it.
So, Patrick, we talk about this being the most important event of the week. We should probably change that to kind of what caught your eye this week. And so let's start with you. What caught your eye this week?
Well, definitely the story was that whale of a trade in the S&P options market. And it's a lot of people were comparing it to when Warren Buffett went and back in through 2004 and to 2008, he did a wave of put selling on the S&P 500, and it was huge size back then. Warren Buffett took a ridiculous amount of heat because he was early to the trade. But this time around...
Whoa, 1 second. He also took a ridiculous amount of heat because he called derivatives weapons of mass destruction, and then he was the biggest naked put seller of them all. Okay,
but listen, let's be realistic. He had the cash to cover it. I think, he had $37 billion of put rights sold back then, right? But he was sitting on a huge amount of cash. They were a European settlement, and they were European settle out 15 to 20 years. He had plenty of time to come up with the cash, don't you think?
Oh, for sure. And not only that, he actually negotiated a great deal for himself where he didn't have to put up any more collateral if it went against him.
Yeah, he collected the premium. He had to put up more collateral if his credit rating got downgraded. So it was the fact that his credit rating was so pristine that Goldman was willing to let him carry it with just the goodwill of Berkshire Hathaway, right?
I guess that's the benefit of being Warren Buffett.
That's the perk, right? But then, but what's the disadvantage of Warren Buffett? Well, you're so big that there's no one to trade against you.
That's true, actually.
Like when
So
you
let's
take a
talk about-
$37 billion trade, it's not like you're gonna find some retail schmuck who's gonna take the other side of that deal.
That's right. He's not. When you're phoning him up looking for an offering on a Ford lot, he's not saying anything. Okay, so let's go on. Let's talk about this trade.
So here, this is just a CNBC headliner on this. So this guy goes out there, or this trader.
Yeah, that's right. Female.
Put out there 19,000 put options on the S&P 500. Now let's clarify.
Trade.
It's a big trade. Let's clarify. This is not the SPY. This is not your $260. This is the full European settlement big boy cash put sell, and so that means every one put you sell is essentially like $250,000 of exposure, right? So like, I mean, this is pretty much what, like a $5 billion deal.
1 second, Patrick. I think you get on your math wrong. Okay, there you go. It's you know what? It's a good thing you don't do anything with numbers for a living. It's actually closer to $4 billion. But yeah, it's a big trade.
Okay. 4 billion, 5 billion. I mean, that's $1 billion is just a rounding error, right?
That's right. So it's a big trade, and
but yeah, 4 billion. All right, and so let's go through the particulars. So this trader, like they compare it to the famous Buffett trade type of thing, but to me this is much different, and let me explain why it is. They're both European settlement, but this trader only went to 2020, so you're talking about just a year or two. Just again rounding, a year or two. But he turned around and obviously put it on. But Buffett had the benefit of going out 10, in some cases 15 plus years. So there is a lot of time for even a bear market to occur and a bull market recovery to bring you back. On 2 years, you got to be dead right where we are on the cycle.
Yeah, no, it's a ballsy play.
It's not that very ballsy play.
It's not that far out of the money,
$4 billion on the line. Now, but now let's be okay. They did do it more than 10% out of the money. We're down to 2,100 strikes. So we're right now.
It's 21% out of the money.
It's okay, 21% out of the money. And so I mean, there is a cushion that this trader has. But like what Vega exposure did you say he had?
I saw someone on Twitter, one of the institutional guys on the floor, said it was $17 million of Vega. So that means for every 1% move in vol, it costs this trader $17 million.
Yeah, just a
so you know what I was kind of laughing at? Could this be the Fed put? Think about it, 21%. It's basically a bear market. He's selling it. Yeah.
So he's betting that
he's betting that if we go down there, Powell is going to once again be easy.
Very ballsy move to this trader. If that trader, whoever you are out there and listening to the Market Huddle, it's one of your staple shows to listen to. Very big balls. That's a lot of courage, because I personally think you're going. Look, here's my view. I think he's going to get in the money, but at some point, but now by the end of the trade, he might be fine. But I think at some point he's gonna be pressed on that margin. That's
right, and it's not going to be like Buffett, where Buffett didn't have to put up any more collateral. This is actually an exchange trade, and he's actually going to have to, he or she's going to have to put up money if it goes against him or her.
One of the advantages, let's see, a lot of our listeners are retail traders, and they're always like, those big boys have this advantage over the small guy, but there's a massive disadvantage the big boys have, and that's liquidity. Because a small retail trader can buy, later sell, and no one even noticed they were there. But when a trader like this puts on a trade with like $4 billion of potential assignment risk, you can't go unnoticed, and there's a counterparty to you that's going to have to be there. If you, let's say you wanted to close this out in 6 months. Let's say the S&P is 100 S&P points higher, and 6 months of time decay, and he wants to get out. Like the market maker, you tell me, you know the side of the business more than I do. He's going to have a hard time closing this out, isn't he?
Well, yeah. Why would anyone buy it at the same vol that they sold it at? Or, sorry, in terms of the market maker, they bought it at this vol, and they're going to, when they go to, the client goes to try to buy it back, it's going to be offered higher. And when you're talking 19,000 contracts, it's a big move. Like, it's not something that you do on a quote. So,
When you do it in this size, you have to have the conviction to hold to maturity, don't you?
well, no, they could also just live with they could be.
They could accept the fact that they're getting shaved.
That's right, and they just go, okay, it cost me a vol point or two to get in and out, and that's just what it cost me, and that's how it works.
So we have this slide here that shows these trades. So why don't you explain to our listeners what they're looking at here?
Well, these are the actual trades on the day of, and you'll see the big one for 13,500 contracts at 1045.
Right.
Most likely, you'll see the ticks.
320.
That's right. I'll bet you that given that there was it's actually going the other way. So it was 93.20. If you look, there was 100 lot printed at 93.80, and then it ticked at 93.20. So I guess if you probably assume that the quote was probably something like 93.80 to 94 or something. So that extra 60 cents or something that he had to pay to
do that kind
get
of
the trade.
size.
Yeah. I suspect that it was already marked down, and that was just somebody else getting involved. The first tick was 96.14. Of course, you need to know what was happening to the S&P at the time to really get a sense of what the true bid offer is in terms of vol. But given this size, there's very few people that can take the other side of this trade. Like
the dealers putting on huge exposure in his book.
Yeah, no, this is a big trade that's was probably a Goldman or Morgan,
one of the big boys.
Yeah, J.P. Morgan. It was somebody big. Like that's a lot of Vega for somebody to look around.
I'd love to track this. Let's see how this trader does. I mean, we should be able to see if this guy's forced or closes out at some point. But we should just track this and see how this trader's doing. Maybe do an update in 6 months and see.
You know what the trouble about this is? You don't know what he's got on the other side.
Oh yeah, of course.
For all you know, he could
argument,
be
right.
Right, like
the argument here in the story was that they were trying to make this this kind of assessment here that where was the thing? He goes, some market participants guessed that the trader was likely hedging against another position rather than an outright bet on stocks while rising. It says the natural sellers of long-term downside puts are structured product desks at banks who are hedging exposure to get from that they get from their retail clients. Come on, give me a break. Hedging $4 billion.
Yeah, I think it's too big
product.
to be that as well. I personally think it was an asset allocation decision by like a pension fund or somebody like that.
Someone with big size, and maybe what they did, let me kind of offer you is this, okay? What if in this whole VAR event, all of this massive deleveraging where all these big funds had to sell down risk and they're being forced to liquidate things out. What if a money manager, having known that Buffett did this in the past, said, look, we've got a massive allocation to cash. We're not buying back into the market here. But if the market shaved another 20% off, we're willing to take equity exposure. We're going to make some income for sitting on cash.
That's actually a great point. Because also, what if you think that the stock market is going to be flat for the next year or two? Which
I just think that if somebody was forced to raise cash and is going to stay in cash,
but not even forced to raise cash. What if somebody just thinks I think the stock market is going nowhere for the next 2 years? Why would I be long stocks? I'd rather down 20%. I like them down 20%. I don't like them here, and that's most likely what's happening.
Yeah, long as they have the capital to carry it, and because you don't want, if the market does get a dump on the downside, you don't want to get margin called, right? And as long as they can carry it, then I mean, you are buying the market at 20%, or at least getting exposure to the market 20% down, right? And
you're buying it down at 2,100. That's what the
it's cash settled. It's European style cash.
Yeah,
settled, right?
but
so
you're
not
long at that point. You're actually synthetically long.
You're synthetically long. You're right. All right, it's a great story. So, Kev, though, let's move on. What did you want to talk about this week? Caught your eye?
It was another trade that was a big one. It was the Steepener, and there was a
Someone was listening to macro voices to the
yes,
the title of this week's episode of Macro Voices was "Fear the Steepener" with Charlie McElligott.
yeah,
And so clearly someone heard that interview and said, "I got to put it on the Steepener."
that's right. So if you go to the next slide here, Patrick, you'll see that this is the 210 spread, and we've gone from 2013. This spread. Now this is the spread between U.S. 2-year notes. I guess they're notes versus U.S. 10-year notes. So how much extra you earn by going out those 10 years. You'll see that in 2013, this spread ticked at like 260. And now today it's ticking down at 17 basis points.
It was down about, it was as low as a 10, wasn't it? I think.
Yeah, no, it did tick down.
But what's interesting, and one of the observations I was talking about was that and we've had this conversation on this show in the earlier episodes, but we've already seen the steepening on the 530s. And it's still, and the 5s, 30s, 10s, 30s, the long end of the curves are already steepening. But the when you're talking about the short and 2 and less, the interest rates haven't moved enough to actually have any yield curve movement, or at least not yet.
That's right. The 2 and 10s are moving a lot less. The 210 curve is moving a lot less than the 530 curve. And so let's go on to the next slide, and I'll show you the trade that was happening. Well, this was there was a big block. There was 19,000 of the TYH9s, which is the 10-year future, and that traded at 121 in 1930 seconds. And then there's 35,000 of the 2-year future, trading at 105 and 31.7 or whatever that is, 30 seconds, so almost 106. So what I did was I just kind of wanted to walk our listeners through it so they understand what this trade is about. When we talk about the Steepener, what do we mean? So what I did was I put in these positions into the Bloomberg to show the duration management, meaning like how much based upon a basis point move in interest rates, those positions would move. So I put in 35,200 of the 2-year future. So that means for every basis point, it moves $1.41 million.
Okay.
And then I put in the 19,000 of the TYH9, which is the 10-year. And so for every basis point move that moves, and you need a lot less of them because a basis
That's a volatility adjustment.
That's it's duration. It's bond math, but yes, and it's also 1.41 million, and you can see right there this it's spot on correct. So what they're showing there is that trade, both of them are kind of duration neutral in terms of the if the spread doesn't move, they aren't going to move. Like if the 2-year goes up 2 basis points and the 10-year goes up 2 basis points, then that thing is going to be neutral. Nothing will have changed.
Yeah.
And that is in essence how the big traders execute steepeners. So what that trader is hoping that happens is that the 2-year, the yield
goes down, or the bond goes higher at a faster pace.
That's correct.
On a trade-weighted basis, right? Like on terms of the sizing, because they're.
That's right. We're hoping that the long end of the bond market sells off more than the short end of the bond market. And so,
which I think this guy's going to make a lot of money because I agree with this trade.
You'd agree with this trade. We'll talk about that in a second. Let's just go on to the next slide. For those who want to play this at home, like because you're not trading a 35,000 lot, here's a little bit of a lower number. So this is what most retail or even small CTAs will trade. They'll trade something like this. If you go look, you'll do 11 of the 2 years versus 6 of the 10-year. And that on the right, it doesn't match up perfectly. It's $440 versus $444, but it gets you close enough. That is how a retail trader would go about executing this spread. So now let's talk about why you might want to do this spread. I think we both are kind of bullish on the yield curve, but probably for different reasons. Why don't you tell me what you think?
I'll say that my idea is not completely original because I've heard it from guys like Charlie who are just on macro voices, but I do have to, in principle, agree, which is that it's going to be the bull steepener, where it's going to be the Fed acting on the short end that is going to steepen this curve, and that's in principle, I actually think that that's where the trade is. But you have a different view. What's your idea?
Well, I think in the long run that central banks are going to be easy, and that they're going to lower rates, and that we're going to get inflation. So that's kind of where I'm coming from a long-term perspective.
You and your inflation there. Oh.
Yeah. So
honestly, Kev, you got to drop it. You've been looking for inflation for how long, and it's never showed up. Anyway, I just at some point you're gonna have to accept that you're wrong.
No, you're absolutely correct. That at some point, it's just not now.
It's just not now. Okay.
Yeah.
All right. So
actually,
this inflation boogeyman's about to come, and
Yeah.
Kevin's ready. And
so
Kevin is ready.
listen, you can put it on my tombstone.
Yes.
Kevin Muir. Here lies Kevin Muir. He was early on the inflation call.
That never came. It's
That
not just
never-
early.
That never came.
Eventually, we'll have inflation.
So
Soon as central banks drop the ball and get it. Anyway, that's
So
a
to me-
broader conversation to have.
So,
but
to me, it comes down to that. Like Powell has surprised me at how diligent he was at raising rates. I've been surprised at the kind of how much fortitude he's had in getting to this point. Right. Now, I've also been surprised at how quickly he's flipped once things got a little ugly. But I really think that, like you see Draghi going, and the moment something goes bad, he's talking about lower rates. Japan's talking lower rates again. Nobody is expecting to raise rates. And I just don't see it. Like, basically, the U.S. has been the only country out there that has actually managed to raise rates. I guess Canada's done it a little as well. But even then, it's what? We've moved up 200 basis points off of zero. So and 200 basis points off zero, and then all of a sudden he's already flipping at the first 20 or 15% down move in the stock market. So I look at it and say to myself, what is, if I'm kind of constructing a portfolio for the next kind of decade, are we going to really see central banks that are kind of hawkish and that are truly trying to keep inflation down, or are they going to do everything they can to create it? So I don't know why you're betting against them.
I just think that they're going to have to cut interest rates back to zero as soon as the cycle turns here. And I think that's the most immediate move is that there's a trade at the 2-year.
Well, okay, so you and I agree. I guess you think that we're going to suffer from a deflationary collapse, and therefore then the Fed's going to have to come in and lower rates very quickly to zero.
Deflationary collapse is pretty extreme. I would say disinflationary pressures, asset deflation, and they're going to pump some money in through making credit easy to kind of try to stem that decline, because sometimes those things become a feedback loop that feeds on itself. So you pump some liquidity in to try to stop the ball from rolling down the hill, right? So I don't know if I want to go and make it like a Peter Schiff extreme here, but anyway, I think that they're cutting. They're going to be cutting.
If you look traditionally, the Fed's always been late,
and they will be again.
Yeah, well then you shouldn't be doing 2 years. You should go out to 5 years. It should be the 530s that you go do. The 2s are more anchored by the Fed expectations, and it won't be till the very last little bit that part of the curve really kicks in. And I contend that Powell is actually more of a different breed than both Yellen and Bernanke, and he will be slower than most expect to cut rates. So I guess
we'll leave it at this, but I want to just ask you something. All right, okay, Steepener, we're going long one, short the other. We're pairing the trades, but let me ask you something. Really here, look, okay, take a. I remember in Just Markets podcast webcast by Gunlack, he was basically making the comment that if you just buy the 2-year yield and hold to maturity, that you've got a positive real return is not a bad trade. And I kind of look at this here, and it's like, why pair it at all? Just going long 2s and 5s at this stage and getting a real yield, I think is just a reasonable trade to just be long. I don't think you need to go against the short. I mean, I think if you want to be hedged, if you're going to put it on with really big leverage, you want to probably pair it as a steepener trade. But I think if you're not going with crazy leverage, you can just trade the bond straight long.
Well, I think that's the Druckenmiller trade. He loves the 2s and 5s, the short end of the curve. He thinks it's going to be a great trade, and he owns, I believe, until Powell went and kind of tapped out and did his cave-a-thon. Druckenmiller was saying that was going to be the trade, was just basically.
Well, great minds think alike, so this is great.
Oh, there you go. You heard it here. Patrick comparing himself to Druckenmiller.
Oh, wow. Okay. All right. Let's move on. Kevin, this week in trading history, what are we looking at?
Well, I'm going to take you back to 1991. January 16th, 1991, Operation Desert Storm began. And I think it's actually a great story in terms of how the markets reacted and what it meant. And I actually stumbled upon, I was doing a little research into this, I stumbled upon a frontline kind of documentary on it, and I had forgotten so many details, and it was great. I'm going to put a link in the weekly handout of the email. Make sure you sign up for it, because I think it's a great kind of refresher about what happened. And while I was listening to it and going through it, I thought to myself, it's been a long time since we've had any sort of geopolitical event at all.
Yeah.
Like tell me when the last time the markets were really...
Well, is Donald Trump a geopolitical event?
No. Like I'm talking
how about the Brexit and stuff like that?
No, that's not, like I'm talking about like a geopolitical event with like a war. Like it's been a long time, and I don't want to like wish it. I'm just like markets you should deal with this. I guess the last one that we had was when Putin went into the Crimea, but it was over in a week. It was no big deal.
There wasn't really a confrontation. He just kind of walked in and took it.
Yeah. So I went back and and watched this PBS documentary and was reminded how Hussein went in and took over Kuwait, and I remember actually how he amassed all these troops at the border, and everyone thought he was bluffing. Nobody thought he was actually going to go out and take over Kuwait. They all thought he was just trying to do it to get the price of oil up, and they said, no way, he's never going to do it. And the interesting thing was Kuwait had actually even gone as far as to stand down their troops and send them off for summer break because they didn't want to provoke him. And then what he did was in August, he marched in and took over Kuwait, much to everyone's surprise. And we go to the chart here, and we can see what the stock market did. The S&P the next day, August 2nd, 1990, Iraq invades Kuwait. The stock market is trading 360. Isn't that quaint? This is the S&P 500. Yeah. It's trading 360. It very quickly trades down to 300 kind of in the next 2 or 3 months. As the
very similar drop to what we had percentage-wise today, like in the last month or so. And we didn't have a war, but anyway, I'm just comparing the magnitude of the drop.
And then it kind of rebounded in the next little while as the kind of tensions, and it looked like maybe that they would come up with a solution.
But I mean, that's not in a while. Like, I mean, we're talking 6 months later.
Yeah, but it took a long time. This was like he invaded Kuwait in August, and you go look at it. It was January 16th, 1991, when they actually went back to war, and with the coalition, George H. Bush went and actually made the coalition of everyone and went and took it over. Went and drove them out of Kuwait. I have a funny story to tell you, and actually it relates a little bit to your vol trading story of the big whale that sold all those $2,100 puts.
Right.
And this was a story from my boss, and I wasn't around. I think I was still a young lad at the time, working at a discount stock brokerage division of Bank of Montreal at the time. But he used to tell me, my boss at RBCDS would tell me this story, and it was when RBCDS was trying to get into the option making business, and he facilitated a client trade that wanted to buy some straddles. So he went and did this trade, and he sold volatility, and I can't remember when it was. It was sometime in 1990, and this trader went and sold all sorts of volatility, and they didn't know what they were doing. And
so your boss was thinking that this is just a freebie, right?
Yeah. So yeah, because volatility selling so easy, right?
Yeah.
No, my boss was actually at the time just a junior trader, but he used to tell me the story, and we used to laugh about it all the time because they sold all this volatility. And first of all, he sold it, and by the time that it got to the final hands, it had been kind of gone through 2 or 3 brokers and been marked up. And that's how low they had sold it. They sold it like, I can't remember, it might have been like 12 volatility, like or 11. And then it got marked up to like 16 by the time the final buyer got it. So they were short all this vol, which means that as the stock market goes down, they have to sell more. And as the stock market goes up, they have to buy more. And the trader at the time decided to just kind of let the position ride, like let the delta ride. So as it was going down, he would get longer and longer according to the model. And all his bosses would say to him, are we in good shape? And the guy would always say, yeah, we're in great shape. Everything's great. And that was always the joke because you'd come in and be like, we're in great shape. We're in great shape. And then sure enough, what happened was he was hiding how long he was getting. And he was too scared to tell them that they weren't in great shape at all. So come January 16th, on the day like when the planes are in the air and they're like bombing the shit out of Kuwait, and it's like this is terrible, and all the stocks are no bid, there's nothing going on. This guy comes clean to the risk managers. He says, we're not in such great shape after all. So they find out very quickly that they're long millions of dollars or tens or hundreds of millions of dollars of stocks, and they start selling it. And my boss, who was working on the institutional equity desk at the time, he says, I still remember the trades because they were like, they were coming with us and there was no bids, and people were like, they were demanding liquidity at the worst possible time. And we were doing these prints of like 400,000 or 500,000 shares of these stocks. And he said, the prints were so stupid, and we ended up selling the lows because we were demanding liquidity to try to sell at the worst possible time. And sure enough, kind of, if you look at the chart, after January 16th, 1991,
It just shot up.
Because the war was going terrific. Everyone was expecting there was to be these chemical kind of weapons, and they all thought that it was going to be a long, protracted battle.
And they covered right at the fucking worst possible moment.
That's right. And I think he said kind of within a week they were having to buy it back. So it's just kind of funny story. So we would always, for the longest time, my boss would come up to me and say, and I was running the derivative book eventually for the equities, and he would say, how you doing? I'd always joke and say, I'm in great shape, boss. I'm in great shape.
Did he make you cover it all then?
No, so he wasn't in charge of when I covered, but it just kind of, that was always our laughing joke. So be wary whenever a trader tells you he's in great shape.
All right. Great story. All right, let's move on. Kevin, WTF clip of the week. What do we got in store?
Well, there's news of the China trade negotiations every day on the tape, and I'm kind of laughing because it's moving the markets a lot. We're up again today on some sort of rumor. We were up yesterday because supposedly Mnuchin was saying that they were going to go and actually get rid of the tariffs as a goodwill gesture, which was later denied. And I see the market getting all frothy about it and very excited about it. And I can't help but think maybe this is a little bit of kind of just negotiations beforehand. And I'm not as convinced that we're going to get a good outcome to this. So I decided to make up kind of a little homage to William Wallace. So without further ado, here is CNBC and William Wallace mashup.
Secretary Steven Mnuchin is suggesting a new gambit to break the stalemate between the U.S. and China. The U.S. is weighing lifting China trade tariffs. Easing tariffs could be an arrow in the quiver, according to a source cited by Dow Jones. Meantime, Dow Jones is also reporting that U.S. Trade Representative Robert Lighthizer resists easing tariffs, but we are seeing that intraday lift here. The S&P 500 most notably. Take a look at this because now we've crossed above the 50-day moving average. A lot of market watchers were watching this level very carefully today. And with these headlines, we have easily surpassed that level at this point. So this is something we're certainly going to be watching.
Yeah, this is a big move, and whether there's a little good cop, bad cop being played here between Mr. Mnuchin and the people who would be a little more inclined to compromise than Mr. Lighthizer, who is a well-known China hawk. Whether that's what's going on here, what you see in the markets is a move from basically flat to up 140 on the Dow.
You know, Kev, I feel like I need to go back and rewatch Braveheart again.
Yeah.
What a great scene that was.
That really was
Hold the
unbelievable.
line. Yeah. It's
so.
Listen, my one comment is this. Everybody, even for the last 6 months, knows that Xi Jinping has more
Whoa!
stake.
It's not Xi Jinping. It's Xi Jinping. He's a big
Xi
fan.
Jinping. No, that's your name for him. I'm
That's
going to
right.
actually call him Xi Jinping. But so he has more staying power than Trump. Like, listen, they can allow their economy to weaken. They can allow their economy to take a bigger hit. We always knew that it's Trump that needs the market, and therefore he's got the weaker hand.
I agree. And, I think that the U.S. dollar bulls and the U.S. Stock market bulls will tell you that the Chinese economy is suffering more than the U.S. one, so therefore they're the ones with the weaker hand. And I'm not going to deny that the Chinese economy is suffering more than the U.S. It's bad. There is no doubt about it. I just think that they take a longer term view of things, and that they're not in as
There's no
much a
political
rush.
consequence to the weakness for them.
So
At least not to the magnitude that we would see in the U.S. And that, but you know what, this is going to be so interesting, because I believe that if the U.S. caves, then it's big picture problematic. I feel that the trade war is manifesting. It's no different than the Yellow Jackets in France. The trade war is a result of an imbalance of global trade that's been going on for 2 decades between China and the world, and Trump is simply bringing it to the forefront. But I mean, I think this problem needs to be dealt with now. They can't. I don't think they can fold. They shouldn't fold. Not for the long term of the U.S. I don't think they. Anyway.
Yeah, no, I agree with you. I think they would have been a lot stronger had they brought together the rest of the world against China instead of trying to do it unilaterally on their own. But I kind of, we're getting too much into the what should be instead of what is. And I think we should just talk about the what is. And if you look at it, I tend to agree with you that any agreement is going to be superficial in nature. And given that the stock market is rallying into this, I think that it's going to be one of those things where you sell the headline.
Oh, like you mean like the G20?
Yeah. So I just think it's going to be one of these things where if we get a trade deal, it's going to be very, very kind of just, I don't know, something just to, placate
I don't
everyone.
think the sell-off was because of the trade. Like, the media tries to make it sound like it was the trade war that's caused the last sell-off, and it hasn't. I think the how has central bank liquidity in any way changed, which I think is the real driver of the market weakness. And so I think that any announcement of any form will likely be faded. I'm with you 100% on this.
Okay, there you go. You heard it, which means
so that means it's not going to happen.
That's right. It's going to explode higher after a trade deal.
Whenever me and you tend to agree that it's a dangerous thing.
Kiss of death. Okay, let's move on to the next one. Okay, so Patrick, we're going to try something different. We're going to get rid of the trading tails this week, and we're going to do the trading couch. And what this will be is I've really
By the way,
felt
this is not every week. We're gonna kind of mix it up whenever we
That's
have
right.
if we have a better story for the trading couch, we'll do that, and if we have a better story for the tail, then we'll do that, right? So we're gonna change it up each week.
But this is something I felt very strongly about, and it's when I think about myself as a trader, and I think about my evolution through the years, and I think about what I could have used. I could have used somebody that was just a little more honest about how difficult it was and the mistakes I had made. And too often you go on to Twitter and you see everyone bragging about their great trades, or you go on and you read the Market Wizards and you hear how you read about how smart all these guys are, and you don't realize all the pitfalls and all the problems and all the setbacks that people have had throughout the years. So what I wanted to do was I wanted to have a kind of just a no bullshit, honest to goodness discussion about things that we've done that were wrong, and so we could help other people.
Or key learning moments.
And so I just wanted, instead of it being like Twitter where I'm bragging about all my great trades, I'm going to do the opposite. I'm going to tell you all the bad things that I've done. And so
we're not going to do that this week. We're going to
hopefully you don't make those same mistakes in the future. Yeah. So let's go and we're going to talk about kind of trading when it makes when you're not really in the right frame of mind.
Right.
And this is something that happens all too often, and we're going to have a couple examples. One of them is from Pitbull, which is Martin Buzzy Schwartz, which is a great book from I guess it's from the 90s. I read it so long ago. And he talks about, he's very honest about his trades, and he talks about one particularly stupid thing that he did. And we're going to go through that and talk about that. And then we're also going to talk about a trader that went on to Twitter. We're not going to name his name, but he was very honest, and he talked about how he blew up his account. But before we do that, I want to talk about when I first realized that even I kind of suffer from, not even I, like everyone else, suffer from the same problem. And there's a point where you have a position on and you can't really think straight. You've convinced yourself that this is the smart way to be, and when it goes against you, all you can do is kind of come up with better reasons why
you should abandon it.
It shouldn't. Instead of taking your loss, you sit there and you dig your heels in even more. And I'll tell you the first time that I experienced this, and it was I was working for the bank, and I was doing index arbitrage, meaning that when the futures were mispriced versus the underlying stocks, we would buy the futures.
You buy the basket and offset against the index.
Right, and we would do the arbitrage. Now, the reality is we were also making markets for institutional clients. So the clients would phone up and say, I want an offering on 50 million of the index. Where do you offer it? And we would do it. And then we would go ahead and we would try to offset it in the marketplace. So we had positions on all the time. And so it was a combination of arbitrage, market making, and just pure punting. Like, I'll just be honest, we punted as well. And at one point we had one of these just straight up market days. And I can't remember what the news was. I can't particularly remember, but we started losing a lot of money for the time. And it was me. I had a partner that was on the floor, the guy that would take all the risk down on the futures floor, and I would take all the risk upstairs on the institutional floor, and we would work together and under this one book. And I remember we got offside, and we were doing the ARB, meaning we were selling the futures because they were just bid through cash, and we were doing the ARB, and we would kind of sell 5 baskets of futures and buy 4 because we were convinced that we would be able to buy the baskets back cheaper kind of within 20 minutes, half an hour, 2 hours. Like, we thought that the market had gone way ahead of itself. And it just kept going against us and against us and against us. And very quickly you would like to think that the banks have all these risk limits and stuff, and I guess nowadays they do, but back then it was just kind of a free for all. And I remember we got offside a big number. I can't remember what the number was. If it was it was a big number, and my boss was actually was in another province. He was in Vancouver, and he phoned me up and he's like, "What the fuck are you guys doing?" And I'd be like, well, we think the market's coming in. And he's like, no, you're going to cut this down, and you're going to cut this down right now. Start buying it back. And it took somebody else to kind of snap us out of our just reluctance, we got I don't know how to describe it. We couldn't think straight almost. All we could think about was that we were wrong. The market was wrong, and that we were going to show the market. And the guy's like, and very
that sounds like a very Jesse Livermore kind of story, right?
Yeah, and so I pulled a couple of stories. A couple of pages from the Pitbull book, and I've included them on the handout. But the long and short of it, I'll give you the story. For him, he was trading around. He was tossing around like S&P 500 futures, and he was bullish, and then he got bearish, and next thing he knows, he's short kind of 13 contracts, and the thing goes against him, and it goes locked limit up. And this is in the old days when they actually the limits used to hit.
When lock limit up was a normal thing.
Right. And so the long and short of it is when the future was locked limit up, you could see where the cash was trading. Meaning that the underlying, once the limit was lifted on the future, you could see that the cash was going to be up like another $3 or something. So at that point, it made absolutely no sense to ever sell a future at that locked limit up price. Yet here he was, Marty Schwartz, one of the smart, one of the legendary traders of Wall Street. And he, instead of, going into the bell, instead of covering his short or trying to cover his short or buying something, he decided, I'm going to show them, I'm going to give them a 50 lot of futures, into this lock limit up. So he just handed someone kind of like $2 or $3 of arbitrage by doing this trade that made absolutely no sense because he wasn't thinking straight.
Right.
And he ended up, he lost, I think he said he was offside $1 million. And this was in the 80s or 90s when $1 million was actually a lot of money.
Yeah.
And it was, and he's pretty honest about how stupid it was. And I've heard him talk about it, how this has got to be one of the stupidest things in the world to sell into a locked limit move that that is worth like $2 or $3 higher just because you got to show them.
Yeah.
And so we'll go on, and I know you wanted to talk about this next guy that has gone on to onto Twitter and kind of owned up to the fact that he blew his account up, and he's this guy's actually tossing around some decent numbers. He's talking about he made 450 one year, and then he's like losing 350 or 600 on another year. And
right, and he's openly admitting he's a retail guy. So the thing is that that's a lot of money for retail. Like for institution, that's small chump change. But,
yeah, well, it's a lot of money for anyone, unless you're unless you're worth like 30. If you're losing $1 million, unless you're worth like $50 million, it's a lot of money.
It's a lot of money. No, I'm not trying to diminish that. But what got me about this was okay. So he kind of concludes that people should think twice before getting into trading, and remember that greed fucking kills is the way he concludes his little piece there. But I want to talk about a phenomenon that I have noticed. And first of all, I can say that I experienced it firsthand in my early trading career, but I had the opportunity to train thousands of traders through the last decade, through the different places where I was training traders, including big picture trading. And there's one thing that I have found that is a common characteristic where I can tell that somebody's going to blow themselves up before they even place a trade. You want to know what it is?
Yeah, sure. What is it?
Okay. So it tends to be an older person that has already a large retirement nest egg. So they might have $1 million, $2 million, $3 million saved away for retirement. And what they do is they take an allocation of it, let's say 10% of the money, and they'll take $200,000-$300,000, and they'll say, this is my risk capital, my gambling account. This is where I'm going to take some shots. The majority of my money is safe, put away. I know I'll be able to retire off it. This is my play money. The moment someone tells me that, I know they're going to zero that. And it's a notorious track record for that, and it's amazing, but it's a psychological view. What happens is that if you say, I have enough money. Think of it. It must be at a subliminal level, because I don't think anyone does it at a conscious level. But at a subliminal level, what you're accepting is that I'm going to be fine no matter what, so I can gamble with this. And more importantly, I can give it more room. So what happens is you throw out all your risk management out the door. At least you do far more than you would if the money meant something to you. And what happens is that and then these traders put on trades that they have no business being in size that they probably shouldn't have been in. They lose control and ultimately zero it out, and they abandon it. And I always tell my students or anyone that's trading, it's like, I always say, don't call yourself a trader, call yourself a risk manager. Whether you're if you are seeking higher returns, which some people would call speculating, where you're looking for it to beat the market, you're trying to make 20, 30, 50% return in a year, right? You have to leverage up a bit. But leveraging up or being more concentrated in positions doesn't mean you should let down the guard on the risk management of the trade. You're just upping your leverage. And what happens is that just people cross their wires on this, and it's just a notorious thing. I always say every dollar you gotta protect as best as you can. You have to, in your back of your mind, say, I have to risk manage this money as prudently as possible, and let the market give me an opportunity to make some money in return. And it's.
I think though that what you're kind of discounting a little bit is the fact that when people are faced with losses, they stop thinking straight.
Yes.
And I always have a rule that if you're not thinking straight or you can't sleep, have your position. And then if you're still not thinking straight and it's still not working, have it again. And I'll tell you a great story that from George Soros. George Soros, the famous hedge fund manager, probably the greatest hedge fund manager that's ever lived, although Druckenmiller might be better. But anyways, he used to go, and when he wasn't thinking straight, he used to phone up Goldman Sachs on a Friday afternoon, fax them, this is how long ago, fax them his portfolio, and sell it all, cover everything, and so that he was 100% cash on for the weekend, and then come back Monday and start all over again. He understood how important it was to kind of have a fresh mind and not be stuck with things. Like, how many times do people, if you were making a portfolio from scratch, how many times do people own stuff in that portfolio that they would have never bought if they weren't losing on it right now? Yeah, exactly. And that is the hardest thing, and it's so difficult. And the psychology part of trading or investing is way, way more important than most people give credit to.
Yes.
So we're going to talk about this more in the future. Watch out for more episodes of The Trading Couch.
All right, let's move on. Kevin, let's review the top 5 things to watch, what we reviewed last week. So what was our number 5 last week?
Well, it was actually one of your little gems.
Yes.
It's will the euro break out above 116?
And considering I shorted the euro and faded it off the move toward 116, I'm happy that it's not up there. But it did not break out. I didn't think it was going to. I'm still bullish to U.S. dollar. We'll see whether this ends up working or not. I mean, I don't want to call it a victory by any means. We have not seen a legitimate move yet. But I still think the U.S. dollar rally is the path of least resistance. Okay. What was number 4?
The ton of U.S. economic data next week or this week. Will the economy show signs of rolling over? I guess, the U.S. shutdown is making some of this be kind of postponed.
Well, we'll merge number 3 and 4 together. That's
right.
Which is the shutdown is causing some lower prints, right?
Yeah, well, it's causing lower prints, but it's also causing us not to get some of these numbers. So part of the problem is that we're not actually seeing it. I did notice that today we had a confidence number that had really kind of shit the bed. It was off by like 8 or 9 points versus what they were expecting. It'll be interesting because the shutdown shows no signs of stopping. And how long before this is affecting the real economy, I don't know.
All right. So number 2, earnings. How did we kick off?
Well, we had J.P. Morgan and Goldman Sachs were terrible numbers, but it didn't seem to matter. I guess the market they've already
it's been baked into the cake.
That's right. They've guided it down a long way.
So we had We had Charlie McElligott on from Numera at Macro Voices. One thing that he put into his chart book, he didn't elaborate too much in the interview because we didn't have enough time. We ran over an hour with that interview. He just kept, it was just great content, but we never got to the earnings part. But one of the things he was pointing out is that we had the earnings revisions was like a 2-year record in terms of just the amount of revisions that were going. And one of the things he observed was the fact that markets tend to do well after such a strong revision period because the bar has been lowered so much that's already been all baked in the cake. And I think that's what you saw with Goldman and other things like this, which is like everyone was so pessimistic about the scenario and the downgrades were coming in that it had much more room to have a relief rally than it was that they were going to slam it for a new round of selling. I mean, what negative news would Goldman have to have come out with for it to get slammed another 10%?
Yeah, no, there's a lot baked into there in terms of the negative news.
Yeah. Anyway, but it would be interesting. But I think that with so many revisions down, I have to agree with them that it may not be as negative for the stock market because it's already been baked in the cake.
Well, then let's go into number one. Is this risk rally for real? What do you think?
Look, it beat the fib levels. Yeah, I was.
Here we go. The squiggles are coming.
The squiggles. It beat the squiggles, which is showing the strength that this has. But I actually, like we said earlier in the show, my feeling is that when all this trade stuff comes in, I think that it's going to be faded. So I feel that this is sort of a push of optimism that is going to be faded, and I think it has. I think it'll be faded.
Yeah, the squiggles held for a little bit. I'll tell you one thing that I noticed. Although there's a lot of people like Kramer and some of the long-term permabulls that have gotten well back and kind of are cheerleading this thing higher, there seems to be an awful lot of the fast money crowd that are still fighting it and looking for this thing to roll over. Kind of the hedgies and all that. To me, it feels like they haven't given up on the idea that we're headed lower. And I worry that it's not until they finally accept that, maybe we're headed higher that it'll be safe to short.
But that is within the narrative, because one of the things that I've been sharing with members and even Macro Voice listeners and even we talked about on the show is that I thought that after we capitulated at in the Christmas massacre, that we could end up being even 2 to even 3 plus months where we're backfilling the drop, and that there was going to be this period where the market will be on balance in a distribution phase. There's no way. I still don't believe the stock market is going to be capable of higher highs. So to me,
I have to give you credit, though. You actually did say it was going to take a couple months, and I thought that the rally would be much more short-lived. I contend that one of the reasons that's occurred is that Powell's come out way more bullish dovish than I ever expected, and it seems to be that the central banks throughout the world, whether it be Draghi or all of Powell's kind of board members, they're all trying to talk like the stock market up. And it's between the central banks trying to talk it up, and then Mnuchin and kind of Trump trying to talk it up with the trade deal. It just feels like everybody is kind of joined together to get this thing higher, and it's going there. And so I thought by now we would have rolled over, but I didn't expect quite the support kind of effort that we've ended up getting.
Yeah, so we'll see how it plays out this week. So let's move on. Kev, top 5 things to watch next week. Let's jump right into it. What's number 5?
Well, number 5, don't forget the Americans have taken Monday off. It's Martin Luther King Day. There is no trading in bonds or stocks.
All right. So number 4, I wanted to bring up Tesla because they laid off staff, right?
And 7% of their staff, which is kind of surprising if demand is so strong, but...
Yeah, I mean, if the company is about to blow it off let's be realistic. I am convinced Tesla and Elon Musk are going to find out that when credit conditions tighten, the access to that capital is much harder. And then, what's the only thing you can deal with? If you can't find capital easily or cheaply, like, I mean, you can always find capital. It's going to be a much higher price. And that if they can't find the money they need, the only thing they can do is start cutting. Because they have to stem the cash burn somehow, don't they?
Well, so do you think that they're going to be the poster child of the next bear market?
I do. Chanos has got me convinced. I'm 100% in the Chanos camp. I feel that even if Tesla survives, forget about Tesla getting zeroed and that this thing is thing. I just think that there's nothing special about the company. The other car companies have caught up, and it's going to have to trade at multiples much closer to what the other car companies are. I don't think that there's anything special about it.
And don't forget that, like, let's take Amazon. Amazon ended up being the winner for kind of e-commerce. But don't forget that the .com bubble still saw the Amazon stock price go down 90%.
Sure, but you know what? I don't think that Tesla doesn't have an Amazon edge.
Wow.
Like those other automotive makers have pretty much caught them on almost every metric. Cars are commoditized, and Tesla is just going to be a brand. It's going to be like Lamborghini. It's going to be a brand, and it's going to be there, but it shouldn't be trading at this multiple.
It just the stock price is way ahead of the underlying fundamentals, and so much has to go right to justify a $300 stock price.
So here's the gap. It failed to make a higher high in the last push. There's a massive overhead resistance at 380, 390 up along the top end, but this gap has now approached those December lows. And you know, if that gives out, there's almost nothing going to stop it from revisiting that 250 low it had back down in September, October, if 300 can't hold. So I'm watching. Does Tesla hold 300? So number 3, what's on your mind?
Well, number 3 is the Davos World Economic Forum. And I guess Trump said he's not going. But I guess Mnuchin's going.
Well,
I saw some funny things on Twitter where some people saying that his wife wouldn't miss the shopping trip. Just Google Mnuchin and his wife when they were at the Federal Reserve.
Just the epic pictures that are coming out. You know what? Is there no sensitivity to these things?
Yeah,
it's GQ magazine loves these guys.
Okay, let's move on to number 2. This is important. The Fed has now entered a blackout period ahead of their January 30th meeting. So what this means is we are no longer going to get any kind of cooing sounds from the Fed. The Fed is on, basically, we're not going to hear squat from them. So I think that's kind of important, and not only that, the market's going to get a little nervous about what we're going to see at this next meeting.
Yeah. It's that's definitely worth watching as we go in that. And so number 1
is we have both ECB and BOJ meetings this week, though. Now,
and arguably, so many people focus on the Fed, and rightfully so. The U.S. dollar is the global reserve currency, but the ECB and BOJ, they are the central banks that provide a lot of liquidity to the world that are outside of that realm, and they're watching what they do and what, let's say, Mario Draghi or Kuroda are doing is so important, and they've been pinned. Is there even a rate hike anticipated by the ECB?
No, there's no rate hike. And interestingly enough, after Powell's dovish cave-a-thon, Draghi joined the whole chorus of central bankers that were issuing dovish comments. He came out and he said at a speech in Strasbourg, he said, there is no room for complacency A significant amount of monetary policy stimulus is still needed to support the further buildup of domestic price pressures and headline inflation developments over the medium term. And then he says our forward guidance on the key ECB rates, reinforced by the reinvestments of the sizable stock of assets we have acquired, continues to provide the necessary degree of monetary accommodation for the sustained convergence of inflation to our aim. And this is the part that kind of scares me. He says a well-equipped toolbox comprising both standard and non-standard instruments has proven indispensable in conditions when monetary policy transmission is impaired or where space for interest rate cuts is limited.
Wow.
When he starts talking about his toolbox, things are like Mario's toolbox. You know that there's some stimulus coming down the pike, and I just think you should be careful. He is showing signs of not just trying to get in a rate hike. He's showing signs to go the other way.
Right.
So it's a full steam ahead on terms of dovish words from Draghi, and it should be interesting to see
Germany's
this
numbers are almost borderline recessionary, so you have to think that that Mario Draghi isn't going to be pumping the hawkish angle at all, right?
Yeah, and what we really need is some fiscal in Europe, but that's another story for another day.
That is. Well, that's your top 5 things to watch this week. So, Kev, what is the parting words of wisdom?
Well, I think this one's especially great considering what we spoke about in the trading couch. And this is from Steve Burns, and he says, all your trades must be at a position size that make you unbreakable mentally and emotionally. And that goes to my idea that if you're having trouble sleeping or if you're worried about a trade, you should have it. And I think that was just a great way of summarizing it and kind of putting all of our thoughts in terms of trading kind of wisdom for this week together in one sentence.
Great way to wrap it up. So,
well, Patrick, it's another great show. I just want to take a time out to say thank you to our beer sponsor. It kind of grew on me. I'll go look up a Hops Cascade.
It's amazing
Nugget.
how when you drink beer, the more you drink it, the more you get used to the taste.
That's true. Big thanks to
down.
Collective Arts Stranger Than Fiction, which was a very, very great beer name for this week, because considering what the markets did. Big thank you to them, and it's great. And I just want to say thanks for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our weekly email. I've been working on trying to make it a little bit better with some links and some extra things that.
Sure, it's just a great way for our listeners to get notification when the show goes live again, and to get access to all the charts and the WTF video. It's make sure you register and get all sorts of cool stuff from it. Also, make sure you follow us on Twitter. You can on Twitter get the notification that the show is out at the Market Huddle as well. You can follow Kevin at Kevin Muir and myself at Patrick Ceresna on Twitter. Visit the website. Make sure you share this with your friends if you enjoyed it. And we'll see you all online next week. Thank you very much, everyone.
That's right. Have a great week trading. Take care.